Hello and welcome to Kitco Mining's Digging Deep, sponsored by Snowline Gold, with me, Paul Harris, in which we take a deeper dive into mining and exploration news. Joining me today is David Erfle, editor of Junior Miner Junky. David, welcome back to Kitco.
Thanks a lot, Paul. Always great talking to you.
We have a lot to talk about today, David, but before we start, please note that Kitco Metals and Kitco Media provide news services only and do not offer tax, legal or investment advice. The opinions expressed here are those of the contributors and do not necessarily reflect the views of Kitco Metals. For complete terms and conditions, please visit kitco.com. And of course, if you like what you see, don't forget to hit that subscribe button. David, gold is trading at over $2,700 per ounce, and silver has been over $34 per ounce. More interest rate cuts are on the horizon, and the BRICs and friends are meeting in Russia, pushing to delink from the US dollar. David, how can we pack all of these things?
Well, the gold price has got so many tailwinds now. I mean, there really isn't any headwinds. I've lost count on how many tailwinds there are. I mean, you've got the out of control sovereign debt crisis. You've got central banks buying up gold like crazy. You have real interest rates going lower. You have geopolitical unrest all over the place. A chaotic U.S. election that's unfolding. It's about to take place in less than 2 weeks now. I mean, and as far as the BRICS meeting is concerned, I mean, after Russia was removed from the SWIFT international currency system back in March of 2022, after they went into Ukraine, the BRICS central banks have been boosting gold reserves at a record pace. And this is basically a sign that they're gearing up for a global monetary reset. Russian President Putin, he wants a new global financial payment system to counter U.S. dollar dominance of global foreign reserves. The BRICS summit hosted in Russia this week, I think it ended on Thursday, earlier today overseas, was attended by China's Xi Jinping and developing nations officials. So with around 58% of central bank foreign reserve currencies currently being in dollar-denominated assets, Putin wants to build an alternative platform for international payments that would be immune to Western sanctions.
Now, I can understand why China, Russia, et al., perhaps, though, they want to reduce their reliance on the US dollar. They want to reduce the possibility, to manage the risk of being exposed to sanctions at some point in the future from the US. But for the BRICS members, being under the China or Russia sphere of influence, is that out of the frying pan into the fire, or how will this manage those kind of risks?
That's a great point. I mean, it's basically deglobalization happening. I mean, everybody was working in tandem when we had everybody on the SWIFT system, and when Russia was kicked out of that put a big spanner in the works. And now it's get rid of those dollar-denominated assets and get more gold.
I think a lot of countries in the developing world are, starting to get uncomfortable with China's infrastructure investments and what, they're starting to realize that what potentially that means going forward if they're so indebted to China, and, going into a BRICS currency or settlement system could have similar ramifications.
It could, yes. I mean, the dollar's not going away anytime soon. That's for sure. But it's a slow process as far as a new currency system to try to get to lower the dollar, having these countries having to keep their reserves in dollar-denominated assets.
Now, as you mentioned, David, there's many tailwinds that have driven the gold price over $2,700 per ounce, and we are starting to see the impact of those tailwinds and that high gold price on company results. Newmont is the first company to report, or the big companies to report, third quarter results, and they reported a solid quarter this morning or late last night, with the gold price pushing net income to $936 million, although their all-in sustaining costs continues to rise to more than $1,600 per ounce. The company said it will spend an additional $2 billion to buy back shares, having already spent $750 million to do so this year. David, with Q3 results season now underway, will other gold producers also post bumper results?
Well, I expect they will, Paul. I mean, the average gold price in Q3 was up over 28% year over year to an all-time record high of $2,477 an ounce. And I think that was like $140 higher than Q2's average at around 23.37, 38, somewhere around there. So over the past 4 quarters, the global miner GDF, ETF GDX, the top 25 companies in that ETF, their average all-in sustaining costs have been trending lower on balance and averaging just under $1,300 an ounce. So this is will likely contribute to gold miners reporting up to a record of over 50% margins on average. I mean, I know the $16 the $1,600 all-in sustaining cost spooked investors, spooked Newmont investors today. The stock's down over 13% last I looked, but basically the high margin mines that they acquired from Newcrest that they're divesting, I think they've already divested a couple of them. Those were in the Q2 results, and it resulted in higher all-in sustaining costs. So I expect their Q4 will probably be lower, and I also expect the gold price to be higher in Q4 as well. So basically, and now with miners generating so much free cash flow, they have little choice but to make acquisitions and strategic investments. I mean, these the M&A transactions have heated up recently because both gold and silver continue to rise. So the miners feel increased pressure to add more ounces via takeovers of undervalued late-stage juniors and small cap, single asset, growth-oriented producers. Record-breaking metals prices have been fueling increased mergers and acquisitions and even expansions since mid-August as the gold price moved above $2,500 an ounce. That was the key. As soon as it rose above $2,500 an ounce, that's what sparked this latest M&A wave.
Now, David, of Newmont, the assets they're looking to divest, they have an average all-in sustaining cost of about $1,800 per ounce. So once they've gone, yes, that will bring costs down. However, I think 2 or 3 of the assets that will be part of the portfolio of 11 that Newmont is retaining also have all-in sustaining costs above $1,600 per ounce. So not out of the woods yet. And also, Newmont's CEO gave a very enigmatic remark this morning during the conference call. He said costs next year will be in line with trends seen in this year. To me, it's unclear whether he meant that Newmont's trends, i.e. continuing to go up, or just industry trends of sort of leveling out. So a lot to see perhaps in the fourth quarter. Now, let's talk about some gold financings. Montage Gold announced an $825 million financing package this morning from Wheaton Precious Metals and Zijin Mining to build its Koné project in Côte d'Ivoire. Wheaton will provide a $625 million gold stream and a $75 million loan facility. Zijin will give a $50 million loan and a $75 million gold stream. Elsewhere, earlier this week, Rio 2 announced a financing package of $150 million to build its Phoenix Gold project in Chile. David, what do you make of these packages?
Yeah, first of all, in Rio 2's case, the expected dilution was minimal compared to how much it could have been had the stock not been up over 50% since the company first began discussions with lenders several months ago, I think, for finance packages. And immediately after the finance was announced on Monday, the weakness for the market pricing in the dilution was being bought even before the stock came anywhere near the public offering price of 65 cents. So, the upsize was announced a few hours later from 40 million to 55 million. And then I spoke with Alex Black on Monday, and he told me that the overnight book was more than 3 times oversubscribed, and the bankers had to make some very difficult decisions on allocations, as well as upsizing the offer. So Rio 2 also had 48 institutional investors take up the financing, which significantly broadens the company's institutional base and is a major positive with stronger hands holding more of the stock. Also, as far as the Montage package is concerned, that was all a little bit of debt and mostly stream related, as the company had already raised 180 million Canadian via equity in mid-August. So that stock is up over 11% today on the news, as the Koné Gold project is now shovel ready and fully financed, along with the Rio 2's Phoenix Gold project is also shovel ready and fully financed. And full disclosure, Paul, Rio 2 is a stock that my subscribers and I have been accumulating since early May, and it's covered in my newsletter, Junior Miner Junky. Also, the Montage is a stock that we hold, which has recently tripled from our cost. So therefore, we sold 1/3 of the position recently to extract our original investment capital from the position. So we're going to hold the rest now risk-free in hopes of an eventual takeover at much higher prices.
Now, David, these financings are obviously very popular and drew a lot of interest. To what do you attribute the interest? Is it, investors now wanting development, wanting growth? Is it potentially a lack of product out there? Do investors think that one or both of these companies will be taken over in the not too distant future? Why such interest?
Yeah, I mean, it's all of those things. I mean, these multi-million ounce projects in safe jurisdictions are rare, and especially the ones with upside blue sky potential that are contained in really large district scale land packages. So, it's basically the wheat separating from the chaff. You see several of other companies that are de-risking similar projects that maybe they're not close to being fully permitted. They're maybe in a top tier jurisdiction like Canada. But as far as Canada is concerned, it takes a lot longer to get these projects fully permitted. So while they may be in a late stage position and they have fantastic economics on their project, they may not be able to get the environmental permit or the final mining permits for another 2 or 3 years. So those projects have been kind of lagging.
It's been a relatively quiet week on the M&A front, David, but with third quarter results starting to come in, it's anticipated that a lot of the producers are going to be starting to stockpile some pretty good cash on their balance sheets. To what extent or not do you think there's a use it or lose it situation that some companies are going to be facing, i.e. they should go out and buy something, if not, their shareholders will pressure them to return the cash they're stockpiling on their balance sheets to the shareholders?
Exactly. I mean, what else are they going to use the cash for? They've already shored up their balance sheets. They're already paying dividends, and they're already doing share buybacks. 3 things that weren't really happening during the last gold bull market 20 years ago, 15, 20 years ago. These companies, they didn't have solid solid balance sheets. They were taking over, lower margin projects with their high share prices, over diluting shareholders with projects that were uneconomic at the time. So, they're generating all this free cash flow. They've got all this cash on the books, and they need to replace their ounces. This sector needs to consolidate more, and what they still need to attract the generalist investor who left 10, 12 years ago and have yet to return, despite the gold price now screaming higher over $27 an ounce, $2,700 an ounce. I mean, we're starting to see outflows turning to inflows now in the ETFs. So that's starting to happen. But we're still not seeing generalists come into the mining sector, and especially into the junior sector yet.
Now, looking at the Montage and the Rio 2 financing, a couple of things really stand out. One, there is an absence of traditional lenders in these packages, and also that there's a lot of they both have streams. They both have streams on their main product, their sole product. How much of a concern is it that gold developers are giving streams on their sole product, and why are traditional lenders not in the room?
Well, as far as the traditional lenders are concerned, I mean, this is a much higher interest rate environment. I mean, the NPV 5% discount rate still being used in most of these economic studies is now fantasy. So the realistic discount rate should now be 8 to 10% for mining projects. So streams can be more capex friendly and with minimal dilution. So, but in any event, the various juniors that are seeking the most favorable financing packages with debt components need to consider inter-creditor relationships and their ability to adjust the financing package as and when the project requires further funding or market conditions change. And as far as the streaming deals are concerned, I mean, that's basically a necessary evil, especially with this cost of capital being so much higher. It's a necessary evil for the junior developers to limit their dilution. I mean, back in November of 2021, as far as Rio 2 is concerned, they inked a deal with streamer and strategic partner Wheaton Precious Metals, which they did the deal with here, and they received a upfront deposit payment of $25 million US from them in March of 2022, and that kept them well financed until they could finally get the permits necessary and then get into the finance stage. So, and as far as the stream is concerned for Rio 2, they're going to deliver, I think it's 95,000 ounces of gold to Wheaton, and it represents less than 8% of the mine's projected gold production. So they're sacrificing, less ounces down the road for more dilution now.
Okay, a more traditional financing that was announced this week was undertaken by Aris Mining. They commenced an offering of $400 million US of senior notes due 2029 to redeem its 6.875% senior notes due 2026. David, money is flowing into the gold space, but it appears to be only flowing in certain specific directions. Absolutely.
I mean, this is basically a good thing. You look at the previous mining cycles when money was cheap and even the turkeys were being financed, but now, with capital more expensive, as I mentioned before, these private equity and lending institutions are being more choosy in the juniors that they agree to finance. So with companies attempting to de-risk marginal projects, having a hard time raising enough funds for meaningful drill programs, it's easier now for speculators like myself and my subscribers to weed out the lifestyle juniors from the more quality issues in this environment.
We have a lot more to come, but first let's take a quick break for a word about our sponsor, Snowline Gold. Snowline Gold is a greenfield gold explorer with a 360,000 hectare land package in Canada's Yukon Territory. The team is rapidly advancing one of Canada's top gold discoveries, the Valley deposit, while also exploring other regional targets. With over 20,000 meters of pending assays, investors can expect plenty of news flow over the coming months. Subscribe for news updates by visiting snowlinegold.com. Snowline Gold trades on the TSXV under SGD and on the OTC under SNWGF. Let's have a drill hit. Collective Mining hit 57 meters, grading 8.11 grams per ton of gold equivalent in what it calls the Apollo ramp zone at 1,100 meters depth underneath its Apollo discovery at its Guayabiles project in Caldas in Colombia. Collective continues to put out very good drill results. It is next door to where Aris Mining is building its Marmato lower mine, and this hit is on the same level as the Aris tunnel. Hence, it's called the Apollo ramp zone. David, if Collective continues to make hits like this, it seems to be a no-brainer that Aris Mining or someone else will have to come in and try and buy them.
I mean, I would assume so. Yes. I mean, and hopefully for Collective shareholders further in the future at a much higher share price.
Okay, we also had a PFS, a pre-feasibility study announced this week by Cabral Gold. They announced a PFS on the gold-in oxide material at its Cuicuí gold district in Brazil. Using a $2,250 per ounce gold price, the oxide project is estimated to have economic values with an after tax IRR of 47.3% for a starter pit, open pit operation with heap leach processing. This is for a 4.5-year mine life with an 18-month payback, with annual production in the initial years of $19,700 per ounce at an all-in sustaining cost of just over $1,000 following an estimated capex of $37.4 million. David, one phrase springs to mind here, and that's go big or go home. Why put out a study for a project with such a short life, or am I missing something big here?
Yeah, I'd have to agree with that one, Paul. I mean, before I even consider taking a position in any junior, and it's like I cover the stock in my newsletter. When I take a position, I put on my major miner CEO hat, right? I mean, so I'm looking if the deposit, looking at a deposit being de-risked by any junior, if it doesn't have over 5 million ounces of gold blue sky potential and it's contained in a district scale size land package with existing infrastructure, preferably in a safe jurisdiction, I don't even consider it. And moreover, as far as the base case price, using more than $2,000 gold as a base case for any economic study is a red flag. I mean, what quality developers are doing now is they've lately been using a base case of 1950 or lower, while including what the margins in the IRR will look like at higher prices, including spot prices.
I do find that quite illustrative and informative when they have those, if the gold price goes to, let's 3,000, 3,500, or conversely down to, $2,000 or $1,700, they give you the range of what they think the economics will be. Also doing a financing this week was Ascot Resources. They're to raise 40 million Canadian as they seek to restart the Miller mine at Big Missouri in British Columbia in Canada. Its creditors will provide up to $11.25 million in new senior debt, and the best efforts private placement at 16 cents a share will seek to raise a minimum of 25 million Canadian. David, Ascot has been another meltdown in the mine development space in the past year or so. Is there a way back for the company?
Yeah, we talked about this one. I think we were at Beaver Creek when they just had that snafu happen where they had to shut down the mine and raise even more capital. I mean, Ascot's road to constructing the mine has been fraught with cost overruns and basically mismanaging capital markets that has really blown out the share structure now, which limits the upside in the stock. I mean, after the company just recently upsized the 25 million equity portion of this finance to 35 million. It's going to be raised via dilution at 16 cents. I mean, Ascot's going to have over 900 million fully diluted shares outstanding. The Ascot story is really similar to another one that took place that I was involved in, but actually before it happened with them, was Argonaut Gold. My subscribers and I had really good profits in this company up until in their attempt to construct its Maginot Gold mine in Ontario. The former CEO and founder, Pete Doherty, was replaced after the company totally mismanaged the mine's initial capex, and then the company was eventually taken over by a serially successful mine builder and producer Alamos Gold, who bought the distressed asset for just $325 million, and now because of it, they're Canada's third largest gold producer. Fortunately, we got out ahead of it, and we still made money in the Argonaut stock, but the upside potential was huge if the CEO had managed the capex better. And basically, I imagine the same fate for long-suffering legacy Ascot shareholders here before the mine is expected to be brought back into production now, not until Q2 of next year. I mean, with M&A recently picking up again during this blistering run, in the gold price into blue sky territory in all major currencies, the gold price is rising and making all-time highs in all major currencies. So Ascot stock is ripe for a takeover by a successful mine operator.
Okay, thank you, David. That's all we've got time for this week. But before I let you go, I wanted to come at you with an unsolicited question. Who do you think, which gold producer is going to have the best 3Q? Is it going to be someone like Alamos Gold? Is it going to be Dundee Precious Metals, Lundin Mining, Orla, Agnico Eagle Mines? Who do you think is going to be the best?
Yeah, Agnico reports next Wednesday on the last day, on the second to last day of the month, on October 30th. I think they're going to have a fantastic quarter because their all-in sustaining costs are below $1,200 an ounce. So I would go with an Eagle. I think that's a safe bet.
Excellent. Well, David Erfle, thank you very much for joining me again today.
All right, Paul. Always great talking to you. Thanks for having me on again.
And for our viewers, if you like what you see, don't forget to hit that subscribe button. I am Paul Harris, and this is Kitco Mining.